Welcome to In It to Win It. This is Steve Barton, and thank you for tuning in. Today, we have a resident energy expert, Doomberg. In today's discussion, we will talk about macroeconomics, precious metals, electricity and AI demand, and of course, the energy markets. As we know, energy is life. Doomberg will give us thoughts on where the global energy trends are headed, what the impact of the incoming administration's energy policies have, and where the best opportunities for investors are likely to be. Doomberg, thank you for coming back on the show.
Steve, great to be with you again, my friend.
Yes, sir, and the pleasure is all on this side of the table. Let's start out like we always do, and what is your macro view of the world economy and financial markets today?
Yeah, sort of a two-pronged approach to answer that question. First, the broader energy markets overall are pretty well supplied, with the possible exception of LNG markets, which are heating up again because of an unusually cold winter in Europe and what seems to be highly irresponsible behavior on a few market participants. I'm thinking of the British in particular, who went into this year with their small levels of storage not even topped off ahead of the winter and are now basically out of natural gas, driving prices higher. But oil is in balance. Coal is barely above $100 a ton. LNG selling for a premium. Natural gas in the U.S. back, below or around $3 a million BTU after the sort of scare of January's cold snaps. All things being equal, energy markets look pretty balanced. We'll see if peace can be achieved between Russia and Ukraine. Really, it's peace between Ukraine and the U.S. at this point. And we're watching carefully what happens in the Middle East and whether or not Iran might be roped into the peace deal that is struck, assuming one can be negotiated between the U.S. and Russia, and whether we don't have a more holistic sort of solution to several problems on the board that Trump seems to be looking for. But then all of that is sort of secondary to the most amazing first 3 weeks of the Trump presidency and what's been going on with the Doge team and some of the things they're uncovering, and then how this is all being interpreted depending on which lens you view the world, and how the two different media landscapes of the United States are portraying this in completely opposite lights. We were just perusing both sides of the propaganda wars. We happen to side on the fact that there's just an enormous amount of fraud and waste in the federal government, and it's long past time somebody did something about it. But nonetheless, what's been going on with the Trump administration has been amazing to watch. It has surprised us, and it has changed our fundamental views on a few really important macroeconomic themes. So happy to take either of those threads in any direction you want to go, Steve.
Okay, let's start with the first one first, and then we'll dive into the next one. And I'm looking forward to number two, I tell you. But one that got me excited here is kind of a bottleneck around the LNG. So I've been watching this. Where do you see the bottleneck? Why would the UK not top up before an incoming winter? Maybe pontificate on that for a bit.
I just think it comes down to competency. We wrote a piece on this whole situation called Out of Gas not that long ago. And, they have amongst this, well, first of all, the UK is the third largest consumer of natural gas in Europe, or maybe even the second largest consumer. It's up there in the top two or three, behind only Germany, perhaps. Yeah, second only to Germany, just pulled up the numbers. And yet it has like a tiny amount of storage capacity. And then even that capacity was only at, 50, 60% in December, compared to 100% in December during prior years. And so at the time that we wrote that piece, they were basically down to a couple of days of storage. And they're running this just in time, import model, basically. They produce some of their own natural gas, but they also import an enormous amount from Norway and from predominantly US LNG cargoes. And they're just running this just in time. So like one pipeline event and the country's in a world of hurt. And it's not just electricity production, Steve. Like the majority of the homes in the UK are heated with natural gas, and these homes are notoriously poorly insulated. It's one of the great internal energy struggles in Britain, which is how do we improve the energy efficiency of the housing stock. And so this was all known, but you have Sir Keir Starmer, I should say, and Ed Miliband thinking that the era of fossil fuels is over and celebrating the closing down of coal plants and installing solar panels in one of the least irradiated countries in the world. The solar capacity factor in the UK is smaller than even Germany's. And so it comes down to competency at some point. And I had this debate with many people. Take Habeck in Germany. He's just not that smart. Like when you listen to them talk, they don't strike you as like intellectually very thoughtful or have anything useful to say. And how do they distill up in these systems? It wasn't competency. It wasn't merit. So, at some point, I just think we have a bad batch of leaders in the West, and leadership matters.
Okay. How could you profit from that? Would that be basically betting on North American natural gas, or maybe distribution or storage facilities? Or
Yeah, I mean, other than trading the commodity itself, which we wouldn't do, and we don't really trade off the work that we produce. If other people find ways to A, agree with us, and then B, find an investable thesis around it, that's great and useful, but we don't provide investment advice. But yeah, I mean, obviously the LNG exporters who are able to sell at spot prices as opposed to long-term contract prices would be an interesting place to start. There's a couple publicly traded ones. I note with interest that a relatively infamous company, Venture Global, is having an IPO soon. You might want to take a look at that offering. They're notorious for refusing to admit that their LNG export terminal is fully commissioned, and they've been selling, at spot prices and kind of stiffing their long-term customers who actually allowed them to finance the construction of the facility in the first place by committing to buying volumes that the bank could then loan against. But that's sort of inside baseball. But yeah, and by the way, like in this market area, you probably want to bet on such management team because they're clearly interested in making money above all else. So there's lots of different ways to play it. But to us, and by the way, it's all artificial. So that's the other thing. Like we don't like to anticipate spikes in energy. A better trade is to wait for the blow off top and then fade it, because you can't really time the spikes, but you can always time the fade. Like these spikes don't last, but when you see an Icarus print on the board, so if natural gas prices were to double from here, instead of 1750 per million BTU, they spike up to 30 because the UK's experiencing a cold snap. You wait for that 30 to drop 20%, and then you ride it the rest of the way down. That's a much higher hit rate trade if we were trading, which we don't do. Again, so I should give that caveat. We're not betting with our own money here, which means, of course, we're not talking our book either. So there's a plus and a minus depending on your approach.
Okay, that gives us some ideas. Thank you. Okay, let's move on to the part two, the one I'm excited about here. Last time we talked, Trump was, getting ready to step into office. I think he was 20 or 30 days away, something like that. We've just been hammering out executive orders like candy, the Doge Committee, the shutdown of U.S. aid, just pontificate on that for as long as you want.
I should say that I have been surprised at the speed and efficiency of the Doge operation. And I guess in hindsight, I shouldn't have been. I had sort of, in my mind, assumed that it was much harder to do this with the federal government and with federal employees than, say, Elon Musk was able to do when he so drastically overpaid for Twitter. And we're starting to see the pushback and various, liberal judges overstepping, I think, their constitutional authority and demanding that, funds be released and insisting that the Secretary of Treasury can't look at payment information. I mean, all that stuff will get fixed over time. But what I think is happening is the Doge team is uncovering so much fraud at such a rapid pace that it's a losing political position to defend it. And yet the Democrats are falling right into Trump's trap. Trying to be as politically objective as I can be here, because our job as analysts is to try to uncover what's actually going on. We're actually going to put this thesis under our masthead later this week. We're going to publish a piece tentatively titled "The U.S. is Not Broke," because it isn't broke. And we've never really written about the U.S. fiscal situation. It's certainly spending is out of control, but the U.S. is far from broke, which is what we're going to get into in the piece. I think if you treated the federal government like you would a privately held company in distress, I think you could cut the federal government in half and nobody would notice. The amount of fraud and waste and grift that is going to be uncovered and publicized is going to shock people. I think it's everywhere you look. The USAID thing is just the beginning. And the reason why they zeroed in on payments right up front is this is how you can see where the money's actually going. And I think that was a shrewd move on their part. So I've completely reoriented my expectations for it. And it has a meaningful impact on our outlook. I think the thrust of our conclusion is that rates have to come down, like big time, because the U.S. is not in a, or shouldn't be in a runaway fiscal train wreck for much longer. We're just doing some numbers. It's pretty amazing, actually. Federal receipts in fiscal year 2024 were higher than total outlays in 2019, just 5 years ago. Okay. Was the government too lean in 2019? Of course not. It was a bloated mess of fraud and mismanagement all the way back to that. Federal outlays are up 50% since 2019. We've basically taken the one-time COVID excess and baselined it and decided that this is the new normal. It doesn't have to be the new normal. 2019, the government was plenty fat. And so in reality, you just need to cut 26% from last year's numbers to balance the budget completely. You don't really need to balance the budget for people to no longer be concerned about the U.S. fiscal dominance or fiscal cliff. A couple of percent of GDP is usually fine. And in some ways, the bond market seems to think that that's pretty good. And so, we have so much to cut on the one side. And I think they're going to identify it. And look, if it doesn't get cut this year, great. I mean, Trump's just going to run on that in the midterms, right? Okay, they're the party of fraud, and we're the party of fiscal responsibility. For once, the Republicans are actually trying to impose some fiscal responsibility. And by the way, it's not the Republicans; it's Trump. I mean, my view is that there's Team DC and Team Trump, and the Republicans have to pretend like they're on Trump's team because they're going to run for re-election under his banner. But if they had if they had it their way, which they did for years, even when they controlled the House, they wouldn't be doing any of this, right? I mean, why is USAID just coming to the fore now? Why did Paul Ryan do it as Speaker? They had the power. The Republicans, the quote unquote Republicans, controlled the House, the Senate, and the presidency before, all at the same time, and none of this was being done because they actually don't want it to be done. They're all in on the grift. And so if Trump is truly going to audit the Pentagon, all bets are off, right? I mean, there's hundreds of billions of dollars of grift in the Defense Department budget. You could audit Social Security. There's ways to do it. You could offer buyouts to younger people. I bet you plenty of them would take it. You could stop paying Social Security for a week and say everyone needs to reapply with a proof of ID, and then see how many people actually reapply. If you need that money and you're real and you're alive, you will certainly apply. It can be done, right? So there's no shortage of discipline. We in the piece, again, we're still in draft mode, and the title might change and the thrust of it might change. But we talk about how in the real world, zero-based budgeting is a tool that you use when a company enters distressed situations. And look, stop me anytime. I could speak for 20 minutes on this, but having lived through in industry crises, I mean, I was an executive during the global financial crisis, and very few companies weren't in a world of hurt back then. And when Alvarez and Marshall shows up at your door and everybody's in crisis mode, and you're negotiating with creditors, and what do? You do zero-based budgeting. You stop all payments and see who cries loudest. And then you selectively and carefully decide what you're going to pay and when, including salaries, by the way, and bills and bonuses and all this stuff. Like, we've allowed this, you can't touch Social Security, you can't touch defense, you can't touch health and human services. And so those are off limits. Well, no, they're not off limits. None of those are mandated by the Constitution. We could look at all of them. Now, look, you need Congress, but I just think it's a losing hand for the Democrats to oppose weeding out fraud and mismanagement. Who's pro that? Who's for that? Right? Like, so in my mind, this is a if it doesn't get swallowed up by scandal and lawfare and all the dirty tricks that whoever's benefiting from all this grift will certainly employ, I think this could be a really meaningful change to the arc of the U.S. fiscal situation, and one that I don't think markets are pricing in yet.
Okay. So in summary, basically you've been surprised at Doge and their efficiency, and the team is coming up with way more fraud than I think anyone thought was possible. I saw something recently about like they're realizing how many people are over 100 years old and still collecting Social Security, and it was way more than people that are actually over 100 years old. It was something like that.
Yeah, I think it's important to distinguish between those types of headlines and the underlying objective, which I think is novel. So the headlines are powerful and important because they facilitate a serious attempt at the underlying objective, which is a zero-based budgeting approach to every line item of money that leaves the federal government, which, by the way, that's taxpayer money. That's obligations for future generations. Of course, we should be doing that. And that it hasn't happened until now is the scandal. So I people say, oh, that's just, a couple of million here, a couple of million there, like Trump's order overnight coming back from the Super Bowl. Apparently, he posted on social media that we're going to no longer make pennies. Okay, that's what, $130 million a year to make pennies. Who knew? Every 130 million counts. Now you could say, oh, but the federal budget is measured in trillions. Yes, but you can't get to trillions without passing through millions. And so those types of metaphoric examples are very powerful politically, and you need that political power to drown out the loud complaints of all of those who have grown up in and have benefited from the system. He is attacking DC. The Republicans will quietly have to go along with it. They'll be just as unhappy as the Democrats, but it's a losing position, in our view, for the Democrats to try to defend that. So I think, look, to balance the budget completely, you need to cut 26%. I've been in companies where more than 26% has been cut. Musk just cut 75% of Twitter. Right? He literally showed up with a sink in his hands, when he took ownership of it. Now, look, I think there are lots of issues with Elon Musk, and we're not necessarily his biggest fans. But if you need somebody to do this, he's probably pretty qualified for it.
Then he's the guy to do it. He's the guy to do it.
And then once you sort of ripped everything apart, and then you start to put it back together, maybe you have a different type of leader involved, a bit more conciliatory, I suppose. But we've always kind of viewed the U.S. as a buffered system. It tends to regress to the mean. And things had gotten so out of whack in the Biden years, and the budget had gotten so crazy, and the amount of grift and fraud. And look, there'll be grift and fraud and scandals in this administration too. It's universal. There's no, but this needs to happen. It can happen. If it does happen, it's meaningful. And I think rates come down if this happens, because the U.S. is suddenly fiscally responsible again. And then there's whole other things that the government can do to not be broke, so to speak. Here's a stat that'll surprise you and maybe many of your listeners. Total U.S. household net worth is almost 5 times the national debt. When the government overspends, it's just people not in the government benefit. Like if the government is spending a lot of money, it's companies and people and employees and so on. Like that money goes somewhere, and it largely goes into the pockets of Americans. A vast amount of that 170 trillion in household net worth, net of debt, by the way, like the average household in the U.S. has never been richer. That's sitting there pre-tax, 5 times the total debt. What's a one-time wealth tax do to our fiscal situation? As controversial as that might be, and so on and so on. But like there's the total government receipts in fiscal year 2024 was 17% of GDP. Deficit was 6%. I mean, this is not runaway train as many people would have you believe. And if that's true, and if Trump is serious about it, and if Bessent is serious about it, and they do uncover all this fraud and waste, and that runs political cover for the hard decisions that will need to be made, you could see this battleship finally being turned around. And we would view that as bullish bonds.
Okay, so 26% cut is the number that we need. That kind of goes in with the VIP's question. He says, where do you see the 10-year yield moving in 12 months? So essentially, you could see it going down, assuming that they're able to continue this. You could see rates coming down simply because our financial situation gets so much better.
Sure, and I personally moved a bunch of cash into just a government bond fund, 7 to 10 year duration. This not, I wouldn't say like I'm a stock picker or anything, but like instead of just having it sit there in cash, waiting to buy gold at any dips that don't seem to be coming, I decided to just park some of it in government bonds just recently. A couple of my friends who I respect deeply believe in the same thesis. I was just talking to one of them yesterday, and he was out with a bullish note on bonds today. Look, yields could go up. I could be wrong. I just, based on what I see and where the puck is going, I think yields kind of have to come down from here. But we'll see. And by the way, that only helps the U.S. because, of course, we have $1 trillion in interest payments, which are not part of sort of direct government spending. Servicing of the debt is a real thing. But if you could refinance at lower rates, and the new Treasury Secretary comes from a world where he deeply understands what's going on, and wrote very critically of what Janet Yellen did while she was Secretary of the Treasury. So it's not like he's unaware of these challenges and what needs to be done. And then the last thing I'll say is the U.S. government is in possession of an enormous amount of assets that are not on the balance sheet. The 36 trillion in debt is on the liability side, but the asset side of the balance sheet is radically understated. 261 million ounces of gold marked at $42 an ounce, 42.2222 to be exact. You remark that now, that's 750 billion. If you add a zero to the price of gold, that's a quarter of the debt wiped out. The U.S. is in possession of 640 million acres of federal land, marked at basically zero. Some of the land is marked at cost, acquisition cost all those years ago. And some of it's not even marked at all, depending on its categorization. 3.17 billion acres of offshore, most of which has been artificially put out of reach for development. The U.S. government controls that. It's all marked at zero. There's an enormous asset base. It has a tax base. It could lean heavily into net worth, percent of GDP. The U.S. is not broke. And people telling you the U.S. is broke either mean the U.S. is spending out of control, which is objectively true, or they're trying to sell you something. And so let's give everyone the benefit of the doubt, but the U.S. is not broke. And in a way, the more successful Doge is, the further yields have to come down.
Okay. I saw a presentation by, where was it? I think it was Joel Littman. He did a similar thing on that the U.S. is not broke. He said, how much is, I'll never forget, he said, how much is Yellowstone worth? What is Yosemite worth? What's the Grand Canyon worth? That's not even on the balance sheet.
Exactly. It's about 640 million acres. What's the gold worth? So just do the thought experiment. I'm not saying this is going to happen. And full disclosure, I own a lot of physical and paper gold. Should be no surprise to anybody who's followed our work. If the U.S. Treasury comes out tomorrow and says we're revaluing our gold at $10,000 an ounce, you could value the gold in the market however you want. We're going to carry it on our books at $10,000 an ounce. What happens to the price of gold?
Goes up.
Right? Goes way up, right? And who does that hurt? By the way, that's one of the things we say in the piece. Like, who are the victims of that? Nobody. I guess if you're paper short gold and you're a bank, I guess they'd be sniffed out pretty quickly. But like no average person is hurt by a revaluation of the price of gold. No voter, no large number of voters are hurt. The U.S. could just announce that. The market could believe it or the market wouldn't believe it. I happen to think the market would believe it. And I think we would see a stampede into gold. You do the same thing with Bitcoin. They could print a platinum coin, and people would argue this is all debasement and all, and they'd be right, but they're not broke. The U.S. is not broke. It is not without tools. And those tools, if they are co-deployed alongside a serious effort to get spending under control, that's the winning combination. And we haven't had that but we've always had the tools. And it's the combination of the two that we think, for the first time in decades, has a chance to play out. And if that's true, that is a sea change in everybody's macro models that needs to be incorporated. Let's see if it's true. Let's see how long it lasts. Let's see how effective the judge shopping is, and the protests, and the federal government employees, and all the sad stories we'll see, on the newspaper, and whether, Trump decides to retreat. He's not given any indication that he intends to retreat on the topic. And in fact, I think the more the Democrats oppose him on this, that in a way, the happier he is, because it's just such a winning issue for him, in our view.
Yeah. Okay, let's move on to precious metals. You alluded to it a little bit here. Dr. Tech is curious opinions on the gold market. Why aren't the miners going up with gold hitting all-time highs? What are your thoughts on that?
Yeah, that's a great question. I don't own any gold miners because they don't seem to go up when gold goes up, and they go down when gold goes down. So it's, at some point it's going to end. I just don't necessarily want to be waiting around for it. So yeah, that is a great mystery, especially some of the more higher quality names. I can understand why the junior mining sector has always been a bit of a casino, and you have highly divergent quality of management teams and all manner of chicanery going on. And so I understand why, nobody wants to own those, or you have to be very selective in what you own, and do your own research and all that stuff. But the gold market in general, I just saw over the weekend that apparently Chinese insurance companies are allowed to allocate to gold now.
No, I didn't see that.
Yeah, so the guy I referred to that I spoke about my thesis around rates is the author of the Market Vibes Substack, Jack Johnston, a really great guy, 50-year trader, worked in the pits, gold and oil predominantly. He writes a great daily newsletter, well, twice a day, a morning letter and then an evening wrap up. And he mentioned that in his morning note this morning. If you just Google Market Vibes on Substack, you'll find him. He's great. You should get him on the show, by the way. I think he'd be a great guest for you. Yeah. He's we sort of helped him out a little bit, and he actually came to visit us, and we talked to him about Substack and how to build a Substack and things like that. And he's a great writer. He's got some great lines, interesting character, great story. And really got, when you've got 50 years of trading experience, he's, trading his own money and talking about, how he sees the markets and so on. He had that in his note this morning. So I take it from him that that's true. He did have a link to it. I just haven't read the source documents yet.
Okay. All right. How about oil and gas? Tony wants to know, he says, how low will oil go? Is there a price floor that basically where, supply starts to affect, we start to have a supply crunch?
Yeah, it's a great question. If you made me just guess without doing a lot of analysis, I'd say 40, because that's kind of like the break-even price for Russia, so we're told, and beginning to be around the break-even price for average producers in the shale patch, and certainly puts OPEC in a world of hurt. The financial break-even price for Saudi Arabia is rumored to be around 95 to 105. I wouldn't necessarily short oil here, because there is a cartel that controls 40% of supply that has a stated objective to put a floor under the price of oil, and we're pretty near that target objective right now. And also, one of the ways that Trump hopes to catalyze drill baby drill is to refill the Strategic Petroleum Reserve, which would be bullish underpinning to the price of oil. And the fact that LNG now is trading above oil on an energy content basis also tends to put a floor a bit under the price of oil, because it reduces the need to switch from diesel, say in China, to natural gas, and makes oil cheaper to buy versus landed LNG. One of the charts we follow every day is 5.8 times the price of LNG, either in Asia or in Europe, plotted against Brent. That corrects for energy content. And so in Asia today, LNG is trading for $96 a barrel. I think it's over 100 in Europe, if I run the math. So you just take LNG in dollars per million BTU and multiply it by 5.8, and you get the oil equivalent price of natural gas. And when natural gas is more expensive than oil, people tend to bid oil. And when natural gas is cheaper than oil, they tend to bid natural gas. And they tend to equilibrate around a mean, which is energy equivalence. And that chart is very instructive. It gives us pretty good insight into the state of the physical markets, which is how I answered, the opening question of this podcast.
Okay, so you see, if you had to guess, it'd be around 40. What is their target price objective of OPEC?
Well, I mean, it's rumored to be between 70 and 90 with a sweet spot in the mid 80s.
Oh, okay.
And so they're at 70 and around 70 right now in that low end of that range. And if it drops below that, it means that they have it could be an air pocket below that. But if you just look at the sort of 3-year chart of oil, anytime it gets around that $70 a barrel range, it tends to be at the low end of the range. Again, ranges can be broken. And by the way, when I say 40, I'm not calling for $40 oil. You asked me a specific question, which is about how low would it have to get before you would wash out that increment of supply and begin to see a turnaround. If you told me that in 3 months oil was trading at 40, that's about when I'd be interested in getting long. But I'm not calling for oil going to $40, and nobody should assume that that's what I meant.
Okay. All right. I'm going to share my screen here just to illustrate your point. And so here's I got it drawn at 67 here, but we're in the same ballpark. You're basically $70 is what you mean. There's just a lot of price action right around there that
and they don't like it to go too much higher than the 90s either. You can see, with blew up because so back to my point earlier, like you look at that super spike up to 125 that we saw when the war broke out in 22. Yeah. Much easier to fade that than to try to time it.
Yeah.
That's our view. And so, that $70 to $90 range. I mean, just look at the last 2.5 years of it, right?
Yeah.
So that's a managed market. There is not organic price discovery going on in oil. There's 40% of supply is controlled by a cartel. They're overtly trying to manage the market. And I think that cartel is getting weaker, by the way. But until you see a real breakthrough below that, it's not something that you would probably make a lot of money shorting from here, I don't think. But again, what do I know? I'm just telling you my observation as somebody who studies the markets every day.
Yeah. Okay. This kind of goes into Mark's question. He says, we're currently in an oil glut. We are at one of the lowest points in history of oil price than gold. Let me pull this is gold divided by oil. If I go out on the monthly, this chart goes out to early 80s, 1983. And so basically, if we follow this green line across right here, we can see what he's talking about. And I'll move this to the daily so we can see it a little bit better. Okay, now it's a red line. But basically, back here in 2016, I think it was, we got up to, right now we're at about 40 barrels of oil to get 1 ounce of gold, or 1 ounce of gold to buy 40 barrels of oil. And we got up here at 2016. We had this was the trade of my life when oil went negative, the kind of an anomaly there. And then here we are again, kind of tapping on it. So basically, he says we have a decade of minimal capital expenditures in exploration and production. What indicators would one look for to mark the bottom in the upcoming trending sine wave of oil production?
Yeah, it's a great question. In fact, I just published on this exact same chart. And if you go back to 2000, for a long time prior to 2000, if your chart goes back that far, oil was fetching about, gold was fetching about 10 barrels of oil shortly after 2000 there.
Oh yeah, look at that.
Yeah. So in our mind, if you draw that line, and by the way, it stayed around 10 barrels per ounce until, just keep scrolling to the right there. I think it was as low as 10 barrels an ounce just before the shale revolution came as well. Yeah. So, yeah, 1,000. Yeah. So we've gone from about 10 to about 40, because if you could ignore the super spike of COVID and sort of squint a little bit, the question has embedded within it the answer. Things like drilling rig counts and capital budgets are backward-looking indicators that do not correct for technical innovation. $1 billion invested in capital today has a whole different outlook than $1 billion of capital invested 5 years ago, let alone 10 years ago. And what this gold chart proves is that technological innovation is far outpacing both debasement and depletion. And that's because the oil and gas companies are technological powerhouses and they are deflationary machines. We are discovering oil faster than we're depleting it. Otherwise, it would show up in the price. And we're getting better and better at finding and bringing that oil or gas to the surface. And then lastly, the very definition of oil is changing, which is something that we have been flagging for some time. We caught a lot of heat when we first posted this about a year and a half ago in a piece called, not quite a year and a half ago, maybe a year and a couple of months ago, in a piece called Peak Cheap Oil is a Myth. I note with interest that one of our loudest critics recently wrote an entire mea culpa, admitting that he was basically wrong on the issue. We're switching engines. So, like, not to get too far on a tangent, but if you look at the carbon count, the average carbon count of gasoline, jet fuel, and diesel, the carbon count grows, right? From gasoline to jet fuel to diesel. That's not an accident. Like, that was the distribution of carbon in oil, and we decided to make gasoline engines that ran on that carbon count, and jet fuel engines or jet engines that ran on that carbon count, and diesel trucks that ran on higher carbon counts, because that was what's available. So we adjusted our engines to the composition of the barrel. Well, we're swimming in natural gas, and we're putting together our Doom Zoom Pro Talk for February for our Pro Tier subscribers. The title is Tread Lightly, Natural Gas Liquids and the Future of Hydrocarbons. We're going lighter. There's a mismatch right now between the hydrocarbons that are coming out of the ground and society's installed base of engines to burn them. We will change those engines, and hydrocarbons that aren't quite matched to what we have today will sell for deep discounts until the engines are changed. And so in the long run, natural gas will be oil. Our definition of oil is any hydrocarbon that finds its way into a refinery network. Well, natural gas liquids go through fractionators. What's a fractionator? It's a mini refiner. So yes, the U.S. has not built a large refiner in 40, 50 years, but we've built scores of fractionators, right? We are drilling for hydrocarbons. And by the way, cheap, clean burning hydrocarbons are always going to be in infinite demand, and lighter hydrocarbons burn cleaner. There's no sulfur. We cook with natural gas in our kitchens with minimal ventilation, but you would never bring your barbecue into your living room, right? And so there's huge advantages to natural gas. And natural gas in the U.S. today at $3 a million BTU is the equivalent of $18 a barrel oil. That's a huge discount. Engines will be switched, people. Like this is what's happening. And so you saw when landed LNG was much, much cheaper than diesel in China, they switched long-haul trucks to LNG-powered trucks, which had the extra bonus of cutting pollution in the cities, which the CCP cares about a lot. And so they switched engines. In April last year, I think 30% of all of the new long-haul trucks were powered by LNG. That has since come down as gas got expensive because Europe screwed up again. But in the long haul, these things equilibrate. And so the actual definition of oil is widening, which puts a ceiling on the price of crude oil, which is having more competitors in the space. So when you look at the price of crude, you're looking at a very narrow slice of the hydrocarbon market. And you have to look at the broader hydrocarbon markets to get a full understanding of what's going on. I'll tell you one small example. In Pennsylvania State, there's a giant ethane-only cracker that takes ethane from nearby shale, natural gas liquids, makes polyethylene. I think billions of pounds of it. It's just enormous scale. In Europe today, all the naphtha crackers are shutting down. What's a naphtha cracker? It takes oil and it makes ethylene and propylene and all the mix and gamish that comes with it when you crack naphtha instead of just doing ethane or propane on purpose. What happens to that naphtha? It goes back into the gasoline market or blended in with heavies, or it pushes down the price of traditional oil because there's more of it. So you're soaking up cheap cheap NGLs in Appalachia, and you're shutting down an outlet for crude in Europe. That naphtha's got to go somewhere, and it gets burned somewhere, and it does so at a cheaper price than it would otherwise be. And we're seeing that across the entirety of the hydrocarbon network. And so you can't look backward at the price of crude as though nothing has changed. The entire dynamic is changing a lot. These things are fungible, inelastic, fungible, technological powerhouses, a deflationary machine, find the cheapest hydrocarbon on the board, and that is the arbitrage against which everything else equilibrates. And the cheapest hydrocarbon on the board today is natural gas in North America.
Okay. It's like you said, every molecule of hydrocarbons will be burned by someone somewhere.
100%. And by the way, the cheaper, the better. They'll change the engines. Like, we will switch engines. Switching the chemical processes that absorb, that make the most important chemical in the world, by the way, ethylene is the most important chemical in the world. That's switching the engines in our mind. You're switching the factories, you're switching the cars, you're switching the trucks. Again, we don't use jet fuel and jets randomly. It's what was available. If what is available for cheaper prices changes, we will change the engines. And the first to do it make the most money.
Okay. Let's see. Following up, he says, how are you certain that the limiting factor of growth in the Permian is gas pipelines and not geology?
Well, let's run the experiment. I mean, as we're talking today, I'll pull up my own chart. Natural gas in the Permian Basin, spot price at the Waha hub is $1.82 per million BTUs. The first time it's been, not the first time, it's one of the rare times it's actually been above zero. It's sold for negative prices for most of 2024. In a world where midstream companies have removed all bottlenecks, NGLs and natural gas, from the Permian Basin, let's see what production will be. And by the way, as we've said before, who cares what the production in the Permian Basin is? There's an enormous amount of oil all over the world. OPEC is holding back probably 5 million barrels a day. Guyana is going to grow. Vaca Muerta in Argentina is going to grow. Venezuela could quadruple its oil production without batting an eye. It used to have 4 or 5 times its current production. There's a huge amount of growth going on in British Columbia and Alberta. Whether we see a slowing growth in the Permian or not, people have conflated this concept. So I'll give classic sleight of hand that we see. The Permian accounts for 80% of global growth. Well, the Permian accounts for 80% of global growth because OPEC has been taking off supply. Right? Like, OPEC is trying to manage the market. So OPEC made room for the Permian. And if OPEC hadn't made room for the Permian, where would prices be? Much lower, right? And so this obsession with the Permian, because of this sleight of hand, we think has led many people to draw incorrect conclusions about the energy markets and cost at least some of them some money. I mean, if you were betting that oil prices were going up in 2024 because of geology constraints in the Permian, you missed out on the stock market. Oil was negative in 2024. In nominal terms, let alone real terms. So, like, in our view, what happens in the Permian is interesting, but it's not predictive. Like, if the Permian slows down, guess who's going to take up the slack? OPEC. They need the money, right? And so, find me a time in the entire history of the energy markets, the modern energy markets, last 100 years, where geology was constraining. It's like fusion. It's always 10 years out. Oh, soon we'll run out. Okay. I mean, it's a sucker's bet. Your cheap oil is a giant short bet on human ingenuity. It's a sucker's trade, Steve. Like, I mean, do we occasionally see super spikes in the price of energy? Absolutely. Good luck timing them. Like, if you want to bet that the Middle East is going to break into a war and oil is going to jump to 125, somebody's going to make money when that happens. It's not going to be me, because in the long haul, you just can't time it. You can fade it. Just go look at every super spike in oil in the past 40 years. What happened within a year? It collapsed 85%. Wait for it to drop 20 and get in and wait. Like, I don't know. It's much easier to time the fade of an Icarus print than to try to get ahead of it. So I know that for some people who are long energy, this might not be what they want to hear, and I'm sorry. But our job as analysts is to try to tell the truth as we understand it. And by the way, if we're wrong, our business suffers. We lose subscribers. The more we get right, the more people subscribe, and so we do have skin in the game. We're just not betting directly on the price of anything because we think that actually influences your analysis too much. And in fact, people who are counting wells in the Permian are almost universally long oil, and they want it to go up. And if I was long oil, I'd want it to go up too. I'm not long oil, so I don't really care if it goes up or it goes down. I just want to understand why and be able to predict it to the best of my abilities for our subscribers.
Okay, so if the Permian is actually plateauing or maybe on its way to decrease production, you're saying that OPEC will simply open up the spout just a little bit more, and the global supply will rebalance itself.
Oh, sure. See, look, we are in a market today where not only is OPEC holding back supply, we're doing everything in our power to make it as expensive as possible for Russian crude to make it to the market. Right? What happens if we lift the sanctions tomorrow? What happens if there's a peace deal in Ukraine that happens to involve Iran as well? Like what happens to the price of oil in that scenario? We have sanctions upon sanctions upon sanctions. What do sanctions do? They make things higher friction and more expensive, right? If the Permian plateaued, which again, I don't see any evidence of it, and B, who cares? The Permian is not responsible for 90% of the world's growth. The Permian has been, people have made room for the Permian because they fear the price going lower. This is what happens. It's not a natural market. The oil price is not a natural market. It's a controlled market. You have to understand when you're participating in oil that it is a controlled market. There is 40% supply under the control of a cartel who has a very specific objective: keep the price of oil expensive. That objective will undermine oil's market share in the hydrocarbon space over time as it keeps oil artificially high, causes places like the Permian to produce more than they should, which comes with a whole lot of associated natural gas, which can't be given away, which becomes so cheap that other people invent ways to use it and change the engines. Like this is why OPEC has to fail. Eventually, all cartels do. And look, full credit to OPEC, probably the most successful cartel in the history of the world for as long as they've been at it. But like that's going to end. So yeah, what happens in the Permian is it gets a lot of clicks. And as somebody in the click business, I understand it. But it's not instructive or predictive.
Okay. Alrighty, let's move on to, I guess we're still sticking with energy, but uranium and copper. Do you have any price forecast for either uranium or copper during 2025? Maybe just macro outlook?
Yeah, not really a forecast. We don't follow the copper markets all that closely, and we're certainly aware of uranium because of our interest in nuclear, and there's probably more bullish tailwinds in uranium sector, but no real strong views either way, other than that there's plenty of uranium in the world too, and so there's only so far up the prices can go before a supply response materializes. And also it's not uranium that's in demand, but enriched uranium. And so there's nuances in the market as well. A shortage of enrichment capacity doesn't necessarily mean it's bullish for uranium, because if nobody can buy it to enrich it, then kind of like a refiner going out is bearish for oil. Bullish for gasoline, bearish for oil, depending on where you are in the supply chain. So no particular strong views in either of those markets, though, except also to say that copper has long predicted that the Green New Deal would never materialize, because you go back on a 20-year copper chart and show me where we're going to electrify everything. It just wasn't there.
Okay. Jeff wants to know, he says, isn't the thesis for increased nuclear energy to power AI data centers here in the United States in need of adjustment given the evolutions in AI power needs?
Yeah, we wrote a follow-up piece first of all, about a year and a half ago, we wrote a piece called Fission Chips, where we predicted that the need to power data centers would normalize nuclear again. And that has proven to be true. Talking about nuclear is no longer verboten. But we wrote a piece in April called Bridge Burning, where we further predicted that dirt cheap natural gas in North America would be used to power data centers. And then we wrote a follow-up piece to that one called Irreconcilable Differences, where we predicted that data center energy needs would have to be fulfilled off-grid. And we watched with interest Chevron's announcement exactly to that effect a few weeks ago, which validated our prediction. What do I mean by that? you cannot add 5, 10, 15% marginal demand to existing electricity grids. It's a public good. It is critical for the functioning of society and the inelasticity of prices given the demand structure of those markets is such that it would cause irreparable harm to average ratepayers to make room for new AI data centers on the grid. So what I think you're going to see is natural gas going in one end of a building and data coming out the other and no connection to the grid whatsoever. We sort of envision them as large AI pods. So it's still eventually going to make things expensive for everybody as turbines go in short supply and natural gas gets soaked up and prices go up. The U.S. has enjoyed an enormous run of incredibly cheap natural gas, which has been a huge boon to our manufacturing sector, which is one of the reasons why we've avoided a recession thus far in our view. And to the extent that the AI boom indirectly impacts that, that's sort of undeniable. But the value of electricity to a data center operator is higher than the average homeowner wants to pay, and it's higher than politicians want those homeowners to have to pay. And so I think it has to be done off grid, and that would at least stall the sort of inflationary pulse that AI would represent to the energy sector.
Okay, so basically, you see that we're going to have more 3 Mile Island stories. We're going to have more like what happened with Chevron right here, because if these AI data centers and Meta just says, oh, well, we'll just buy it from Edison right here, they're essentially stealing from the general population, which would make them mad, and they would get behind their congressman, and they would make sure that wouldn't happen. So you see them basically building their own, or having power companies build them for themselves so that they can tap into that unmolested by the general population.
And it comes with other advantages, which is no need to connect to the grid, and grid connection backlog is large, and there's less auxiliary equipment needed to do that. But on top of, look, I mean, I don't know what the exact elasticity numbers are, but if you added 7% electricity demand to pick your favorite state, Illinois, if you added 7% electricity demand to the state of Illinois' grid, it would more than double the price.
Oh,
it was very, very highly inelastic. You would very soon find out who needed it, and everybody would pay that new price. I mean, this is the whole point, right? Like when Biden released 1 million barrels a day of oil from the Strategic Petroleum Reserve, that sounds like a huge amount. That's 1% of daily demand. 1% of daily demand cut the price of oil in half. Right. And so when you asked me earlier, like if Trump decides he wants to refill the SPR, that's a floor under the price of oil that is meaningful. You could term that out and capture the arbitrage and stick a straw in the ground and point it towards the SPR and pay dividends and stock buybacks all day long. And so, yeah, you have 5, 10% marginal demand on a grid infrastructure that hasn't grown in 20 years. You're going to more than double the price. Yeah. I mean, I'm sure somebody with a pocket protector and a calculator would give a more precise answer than what I'm saying. But directionally, I know that I'm right. You just see it. Just look at what happened when we had the big freeze in Texas. And natural gas traded for the equivalent of $6,000 a barrel of oil, spot market. Like these things are highly inelastic. And so you can't just add 10% new demand to a grid that hasn't grown in 20 years. The only way to get that demand is to destroy the same amount of demand with price. And that's what would happen. So prices would skyrocket. This is why California's electricity situation is so screwed up, because they forced intermittency on the grid, which raised the price for everybody. People need electricity. It's a public good. It's one of the most important things that actually government does. And so, I don't think you could do that. And that's why FERC canceled that deal, right? That Amazon was trying to do, because no, you're going to affect prices. We had one of our mandates is to protect consumers. So it has to be done offline. And again, it'll indirectly affect prices as gas turbines become expensive and natural gas becomes expensive, but it won't directly impact prices in a way that is tangible. Indirect results are easier to defend politically than direct ones.
Okay. All right. Blaine's got a question on DeepSeek AI and electric vehicle demand. What are your thoughts on global power grid upgrading and the effects on copper and uranium?
Yeah, so a lot of different directions embedded in that question, of course. I think DeepSeek is bullish for AI chips I think Jevons paradox holds sway, which states that as things become more efficient, the overall demand for those things grows, doesn't shrink. It's not like we do the same amount for cheaper. We just do more because it's cheaper. And the sell-off in NVIDIA, while NVIDIA might be wildly overpriced, I think the sell-off because of DeepSeek was perhaps short-sighted. There's going to be a huge demand for AI, and we are involved in this space. We don't write about it much. That market would blow your mind, what's going on in the AI space right now. So yes, there's bubbles and there are cons and frauds and all the things that happen when you have a truly revolutionary technological advance akin to the internet.com bubble. But we still have the internet now, right? And what's going on in AI is going to blow people's minds. And it's going to radically alter society in ways that we can't even get our hands around yet. And we've studied it very closely, and we've seen some of the more cutting edge stuff up front because we sort of have some private activities that we do in that space. And so change is coming in a big way, for sure, in the AI sector. And EVs, I think that party's over. I think plug-in hybrids are going to be the winning technology in the long term. Full battery electric vehicle, I think that story has come and gone.
Yeah, my brother works for a major car manufacturer, and I've just watched, as he said, they're pushing EVs. It's going to be all electric vehicles by 2035 to just completely, they're not selling. We're going back to gasoline, diesel, and plug-in hybrids. So
Yeah,
I think he called that one.
I keep a close eye on Tesla's unit sales this quarter for an indication of where that market is headed. Forget about all the other noise around the company and battleground stock that it has been historically. Just look at unit volume. In fact, if you plot Tesla's unit deliveries for the past 3 years, it's an interesting chart.
Is it going from the top left to the bottom right?
It's a flat line.
Just okay.
Yeah, I mean, it hasn't really meaningfully grown in 3 years, and early indications are it might shrink in Q1. We only know this because we follow BYD so closely, right? The Chinese market is where all the action is in the EV space, and BYD is an interesting company for a variety of reasons, and we've written about them several times as sort of a flagship milestone metric type situation to watch. Buffett owns a big chunk of it. We remember when they were a laughing stock in the automotive industry. I remember seeing the first BYD Frankenstein mobile, as we called it back then. It was literally a ripoff of the Toyota Corolla with various other companies' technology under the hood, but it was copy and paste of a Toyota Corolla. I remember being in an auto show in China, seeing it for the first time, and to see what they've become. I mean, they're bigger than Ford already. And so the technology in the EV space is being dominated by China today, and they have their own reasons to push EVs. They don't have any oil and pollution in the cities. So just because EVs are popular in China doesn't mean that in Montana you need one. And that's what I think we're finding out.
Yeah. Okay. Yeah, I got to say you called that one to a T. Okay. Hank wants to know, do you follow manganese?
Not too closely, no. Other than yet another critical metal that we used to make in the U.S. and China now dominates. We wrote about magnesium and manganese and various other metals, that we've just stopped making here, that we're going to have to start making here again, or at least make in friendlier locations than China going forward. But no, I don't follow that market specifically. Sorry.
Okay. And rounding out, Antonio wants to know, do you have any good book recommendations?
Yeah. The book I just finished rereading again for the umpteenth time is The Teapot Biosphere by Thomas Gold, which is a controversial book. And just mentioning it will get people to tune me out. It's the thrust of the hypothesis is that life was created subsurface, and that oil and gas are biogenic, abiogenic, not biogenic. And so the theory is that basically Earth is a giant ball of natural gas, and subsurface life eats that natural gas, partially oxidizes it, and creates lights, and then eventually oil, and so on. And it's a controversial opinion, one that many in the oil industry dismiss. I'd like to read the book every 4 or 5 years just to remind myself of the thesis, because of it's an interesting one. And Thomas Gold is a sort of old school scientist who wasn't afraid to be wrong, and had some pretty far out predictions that eventually turned out to be true. So I always sort of try to pride myself in being as open minded as possible, even when people think it's heresy or it's provably wrong or they don't believe it. Having been a generalist scientist for several decades who has worked in many different fields, and always sort of prided myself on having a feel for what should be right as opposed to, the dogma of the day. I always sort of had a special place in my heart for that book. And so I'm not ashamed to say it. It's a good book. It's an interesting read. There's some interesting evidence in there that's difficult to explain. And so, I just finished rereading it again over the holidays.
Okay. Thomas Gold, The Teapot, what?
Sorry, The Deep Hot Biosphere.
Deep Hot Biosphere.
Hot, as in high temperature.
Oh, wow. Okay. All right. I'll put the link down below and then
Let's do that. Sorry. Yes, The Deep Hot Biosphere.
The Deep Biosphere.
His thrust of his view is that photosynthesis was a late stage development and that surviving on the surface is much harder than surviving subsurface, and that other planets are probably teeming with life subsurface, and then other planets have an enormous amount of methane, and why doesn't the Earth? And so if you view the world as a giant ball of methane, there'll be some interesting developments in this regard this decade. One of them, which we're following closely, which is why we reread the book, is China is drilling like a 50,000-foot oil well.
Oh, wow.
And what are they going to find down there? My guess is an enormous amount of gassy oil. So we'll see. There's lots of reasons why people want certain beliefs to be held in society, and I've never really been attracted to such reasons. I've always tried to and probably to a fault, I've been attracted to sort of out there hypotheses as a scientist, because it's just more fun to at least try to nullify them yourself, or at least read why other people think they're wrong and judge for yourself. And so, interesting book. He could be wrong on oil and still right on life, for example, and that in itself is a very interesting hypothesis that makes sense, one that you really can't unsee after you've seen it.
Interesting. Okay, cool. Thank you, Doomberg. If viewers want to get a hold of you and follow your work, how can they do so?
Yeah, Doomberg.com, Doomberg. All of our work is there. We have our letter, which we're publishing between 8 to 9 times a month now, and our pro tier gets, in addition to that series of articles, a monthly webinar where we'll put together a full pitch or a presentation on a topic. This month is on natural gas liquids, of course. All of our podcast appearances, you could sign up for free and get a bunch of previews and then see the previews to all of our pieces, and then maybe we'll entice you over the line after reading a few of them. Steve, it's always great to talk to you. Looking forward to the next time, assuming you'll have me back on after today.
Of course. Always. Always. Thank you very much for coming back on the show.
You bet, Steve.
And thank you for tuning in. Be sure to support the show and share this with anyone that you think needs to hear it. It's probably your buddy that can't stop talking about tech stocks. You have yourself a great rest of the day, and we will talk to you next time.